Hi, folks. This is Sean Hyman from the Logical Investor newsletter, and I want to talk to you about the stock market sell-off today. And I'd like for you to send this to people who don't know anything about us so that they can get this little tidbit of information as well, so that they can see some of the things that we're looking at, because I'm sure they're concerned about their portfolios and things of that sort after they've seen the Dow dive, over 830 points today alone, and the NASDAQ dive over 4% today alone. And by the way, if somebody is viewing this and you're not a subscriber, again, there's a lot of free content on the site. You can go to SeanHyman.com. That's SeanHyman. So it's SeanHyman.com. And in the Ask Sean section, the fundamental news and charts section are all free. Only the premium newsletter section is not free, because that's where the exact advice is given. So at SeanHyman.com, you can click on the premium newsletters section. You can scroll to anything, just any title, and click on it, and scroll down, and you'll see sign up for the newsletter. What that'll get you is 12 monthly issues that are written and posted on the site, and it will also get you weekly videos that appear by each Thursday evening on the site, where I go through our positions and the market overall, tell you my opinion about all of that, and then also any sell alerts, because buy alerts will appear in your monthly newsletter. Sell alerts will be posted on the site, just like you see right here. We sold EWZ for almost a profit of about 22%. This profit came unusually fast, in about 3 months' time. We are true investors, so we tend to hold positions for 2 to 4 years, but occasionally something happens that will give us an unusual profit in an unusual amount of time. And so anyway, that's an example of one of those. But the premium newsletter section for $97 a year, so was that like $8 and something a month, gives you really detailed advice about the markets, about our positions, exact entry orders, exact exit orders, why we're in them, and in a way that you can understand it. So it really doesn't matter if you have very little stock market background, or you've got a lot of market background but you just haven't been successful, or you just want a second opinion and somebody to watch, look over their shoulder. You can use this newsletter for any of those types of purposes. On the Dow, like I say, just on the one day alone, the Dow drops over 830 points, or 3.15%. The S&P 500, just on the day alone, dropped almost 95 points, 3.29%. And you can see its long drop there. The NASDAQ was even worse. Of course, the NASDAQ tends to lead on the way up. It tends to lead on the way down. And so the NASDAQ lost 315 points, which is a huge point loss for the NASDAQ. It's more like what you'd see on the Dow. And it was over 4% down in one single day. You can look at other indices that are even breaking down either further, like the Russell 2000 Small Cap Index. These are small companies in America that they generally don't have overseas exposure. They're small, and they just have a number of locations, and they're all typically within the confines of the United States, but they're not medium or large companies, they're small. And of course, when the market takes it on the chin, small companies tend to take it on the chin worse than large companies do. So, you can imagine how much the Dow dropped. Well, it spooks small cap investors even, that much, and sometimes even more so. But it was down 2.86% on the day. And it dropped below a major moving average, well below its 200-day moving average. So it's further along in its downward process. And then there are the Dow Transports, which is the Dow Transportation Average, and it was down over 4% as well. So that's going to contain things like transportation stocks like your FedExes and UPSs of the world, and your railroad stocks, and basically a lot of your bigger companies that get commerce back and forth by airplane, by big trucks, 18-wheelers, by rail, that sort of thing. And that was down over 4.05% on the day. big dip there, way below the 200-day moving average as well. So lots of technical damage on charts. But if you're a subscriber, you are fully prepared for days like this, and they don't come as a shock to you because I've been warning you of risks well ahead of time. And we know that there's risk because of things like we can check out the price to earnings ratio of the S&P 500 and see where it stands. And we can also, matter of fact, let me just back up and show you what I'm talking about on PE ratios. This looks like a bunch of squiggly lines, but this measures the average price of the average stock in the S&P 500 with its collective average earnings of the S&P 500, so the 500 largest companies in America. And when it gets on the high side of this range, 18 to 25, that means that the S&P is at a PE of 18 to 25 in that range. That is, you're paying a ton in price relative to the earnings, and historically those PEs go down, and the only way those PEs go down is for the price to collapse against the earnings, relative to the earnings. And so basically, anytime this graph is towards the upper end of this range, and these are just anomalies because these are times when the global economy almost collapsed in 2000 and 2008. So earnings even collapsed faster than price. But here we are again at a PE of 22.75, and so the risks are high. So anytime the risks are high, like in these times, we hold a lot of cash, and we're very picky about the positions we have, and we don't take high risk, which are high PE positions, and we're very picky about the types of companies we get in. Conversely, when the PE, the price to earnings ratio, is down here in the 6 to 10 or 12 range, then the market is typically undervalued, and it's a safer time to be invested, and we may be a little bit closer to more fully invested during those times, and less cash on the sidelines because there's so much value to be had out there, and the risks are typically much lower. So there's ways to measure markets, and that's what we do. We use measurable metrics. We don't go off a gut. We don't go off a feel. Even though I've been watching markets for over 25 years, I don't just go off of what I sense. I go off of fundamentals firstly of the overall market and of the overall company. And so there's a handful of metrics I use there that are all measurable to tell how big a company is, how much cash they have, how much debt they have, their price to earnings ratio, their profit margins, etc., to tell me whether that's a solid stock or not, because it tells us whether it's a solid company or not, and if it's at a cheap valuation or expensive valuation from a fundamental perspective. And that tells us a whole lot about our underlying risk. From there, I look at charts to tell how things are doing and to see if there's risks or not. And there's a lot of risks that are in the market. And one simple eyeballing way that we can tell that is when the sentiment gets overly bullish, and when investors are gung-ho on the markets, in other words, the price of these indexes gets far away from this 200-week moving average. That's on a weekly chart here going back 10 years. So anytime that happens, it doesn't mean the market has to start dropping the next day or next month or whatever, but it does tell you that the risks are very high. There's also other indications that tell us when risks are high. There are certain ways to count these moves called Elliott waves that tell us when the risks are high, and when there's been 5 major waves up, that constitutes the end of an uptrend. And here we are, 1, 2, 3, 4, and we're in the 5th right now. When the price goes up, but these indicators start to slump over downward, the RSI and MACD, that tells you that the market is likely losing upward momentum and is likely to fall. But just if you didn't know any of those things alone, and you only knew 2 things, where the price was and where this one red moving average is, when it gets very far away from that moving average to the upside, you're taking on way above average risks, and you've got very little upside relative to the downside that you could take on. So, it means the market could go up some more, but it can go down 2, 3, 4-fold what it likely is to go up for you. And so when the risk to reward is just not there, it's just not worth taking the risk. And so there are times where we are out of the broader market, even though we'll be in certain value positions. The broader market will be out of when those risks are high like that. And then when the market comes down, again, after 5 waves up, there's a massive 3-wave correction downward, which tends to take this way below the 200-week moving average. And so it tells us that there's going to be risks for quite a while, that even after this 800-point down day on a weekly chart, it's just a blip in the grand scheme of things. And that ultimately the Dow would have to go from 27,000 to closer to 20,000 before it even gets back here. But at the end of an uptrend, it's going to even go a lot further down than that. So this could go, 15, 16, 17, 18,000, somewhere in there before it's all said and done. So it lets us know that the market is risky, and it's going to be risky for a while, because it's going to take a while to wring all this overvaluation out of the market and bring stocks back to a fairer valuation where their price is fairer and a lower PE relative to the average earnings of companies. So the Dow shows huge risks. The S&P 500, the Dow Jones Industrial Average, while being widely monitored, is just 30 mature companies. So while I watch that, I watch the S&P 500 even more, because that's the top 500 companies in America. It's funny, a lot of these S&P 500 company funds actually usually hold like 503 to 505 different companies. So it's roughly 500 companies in America that are the top, biggest and baddest of them all, the largest ones. And we see the risks are very high here. The price is way away from this moving average. The price is slumping over on the RSI and the MACD as well. So, and the same thing on the NASDAQ. So the NASDAQ, you got this big run down, and as big as this 4% daily drop was, and I'm not saying like the next day or two or even week or two or whatever following this, there might be some kind of recoil and rally up or whatever. Not saying that won't happen, but what I'm saying is over time, over the coming weeks, months, and possibly year, there's still a lot of risk and potential downside that is out there that has not transpired yet. So, this is something to be mindful of if you've got a 401k, if you've got an IRA, even if you don't invest in individual stocks. Sometimes the newsletter service might be worth it to you just to get a read on what the market is doing broadly for your 401k and IRA's sake, while you learn more about individual stocks and get a little mini education in that along the way. And even as much as the market has fallen overall, there are asset bubbles out there all over the place. For instance, Facebook had run up big time far away from its 200-week moving average and has started to unwind, but only more recently. Amazon, a trader favorite, ran up and had this big parabolic move and had been in this big bubble, and it's now likely starting to pop, and again has a mile to go before it would ever even reach its 200-week moving average. And when these get stretched this far away, you can almost bet that before it's all said and done, they will stretch, a decent amount below those moving averages as well. So the Amazon likely has a huge fall ahead of it. Netflix is another one. Massive rally up away from both of its major moving averages, is 50-week and its 200-week. And what's it doing now? It's coming back towards them. Google is another one. So, again, they're just all over the place. Micron Technology, massive bubble and starting to burst. AMD's been a favorite of the traders that had just gone and skyrocketed. It seemed like it was going to go to the moon. And anything that goes very far away from these moving averages eventually, comes back down to them. So it's going to have a huge crash, more than likely. Intel, same thing. Microsoft, same thing. So, you can name it. And, tons of the most popular names that you see out there these prices are escalated very far away from this 200-week moving average, and their PEs are high. The sentiment is overly bullish, and novice investors think, well, since the market has gone up for a number of years, then it's going to keep going up for a number of years. They think what has been will be, and that's not the way to look at that at all. The higher prices go, the higher the price to earnings ratio goes. Prices can only stretch so far away from earnings before they have to come tumbling back down more in line with those earnings. Much like housing in 2008, houses seemed to go through the roof, right? 2005, 2006, 2007, and on later into 2007, and for some markets even early 2008, and then everything crashed between late 2007 and 2008. So what happened? Well, prices can only go so far from people's ability in their wages to pay for those houses. So there's kind of an elasticity there. Somebody that can normally afford a $200,000 house can't pay $1 million for a house, using just an extreme example there. So the people that were in the markets for those $200,000 houses, when they go 250, 300, maybe 350, they start to get priced out of the market. And if something goes ridiculous, 400 or whatever, they're just so priced out that the demand dries up because they can't pay for them, and the prices have to come back down to some normalcy. And usually what they'll do is when they snap back, as you saw in 2008, they tumble for a long time, and they'll really go back down to something that's even below average and normal pricing, because at that point, the downdraft in housing has been so long that there's so much fear in the market that people are afraid to step up and buy houses because they see them as falling assets at that time. They know so many people, maybe even themselves, have been burned by houses upside down on their mortgages, gotten foreclosed on, so they're skittish, and so that causes undervaluation in the market. And so stocks do the same thing. When people, by and large, are overly bullish, when the news is rah-rah and everything, and everybody's telling you how peachy it's been for so long, and everybody's telling you how much money they're making on stocks, and all many of your buddies become stock traders and think they're geniuses. Those are the times where you're usually getting your market tops. And it's really where you could throw a dart and just about not miss something and it go up, because the overall market was just going so crazy to the upside. But at some point, everybody who can buy has bought, and the valuations get so stretched that no pros can justify the risk of going in and buying any more. So even if they can buy more, they won't buy more, and it starts to fall on its own weight and come back down, not only just to these moving averages, but even well below them before it's all said and done. And many times that can take at least 6 to 9 months, sometimes 1.5 to 3 years. I mean, depending upon the steepness of the downtrend. Some are faster than others. 1987 was a very swift downtrend, but then there was a period in the mid-70s that took like 3 years for the downtrend to happen, because it was more like a slower downtrend, bear market downtrend. So it really just varies. But when these times start, for sure the market is going to be usually in some pretty bad shape for at least 6 to 9 months. And of course, my subscribers have been prepared. They have a lot of cash, and they were able to get out at high prices, and they're going to have a lot of cash at their disposal. So when these stocks come back down to more reasonable valuations, which will be when the S&P 500 goes materially below this 200-week moving average, they'll start using an averaging in technique that I've taught them, and get a much more favorable price. So what are they doing? They're buying low, and they were selling when it was high. And that's what people should be doing. For some reason, people get in a buy high, hope to sell higher mode, and that's called momentum trading. And that's a very dangerous game, because you're always dependent upon another sucker greater than you buying what you're selling. And you're already trying to sell something that's an overpriced asset to begin with. Whereas we take a value approach and buy something that's truly low and undervalued, yet solid and huge and poised for a turnaround. And so we buy it low, and then we sell it when everybody and their mama wants it. And it's starting, the sentiment's getting overly bullish, And then we bought it when nobody wanted it. You couldn't hardly talk anybody into it. The sentiment was extremely bearish, but yet the company's fundamentals showed that it was a sizable company, a strong company, lots of cash on its books, low debt, low PE. So all the numbers made sense, so we buy. So I use fundamentals, technical analysis, which is charting, and sentiment, which also I view from the charts, as my formula for when to get into stocks and when to get out of them, and then use an averaging in technique that guys like Warren Buffett and others use that help them to get the most favorable price that's possible. So nobody can pick a bottom, nobody can pick a top, but by using a certain technique, you can get closer to whatever the bottom would have been. And so that helps us to get outsized market-beating returns to not only beat inflation, but beat the market over time. So anyway, I hope this has helped you. I hope it helps you to realize the risks that not only took place earlier today on this recording, but also the risks that are out there in the market that still exist, that that this video will still be relevant whether the market rallies 500 points tomorrow or continues to dive, or whatever it does in the interim makes no difference, because these risks are still there. These gaps will still close between where the market is and where these moving averages are. Not only will they close, they'll go well below them, because we haven't had a bona fide downtrend in a while. And so those unfold in three major waves lower, and they go much further than you would ever think that they could go. The last two market crashes and corrections in 2000 and 2008 were both between 40 and 60% retracements back from the market high. So when you talk about massive pullbacks, we're talking about massive pullbacks. Doesn't mean the next one, that this one has to be that big, but it has all the makings of it, because it has just as many bubbles, just as much, if not more, investors and traders on excessive margin, which means they borrowed money to buy stocks. The sentiment is just as overly bullish. The commentators on TV and the analysts are just as bullish, meaning just as overly optimistic. So the makings are still there. Could it be a 30%, versus a 40 or 60? Yeah, it could. But, I help my subscribers dodge a ton of these bullets. Doesn't mean that we can dodge the entire downtrend, but we, and it doesn't mean that we, get out at the very top of the uptrend. But what we do is we exit when the risks are very high, even if the market continues up for a little period, because of what we know is coming, like days like this and periods that are to come. And then we enter when everybody and their mama is unfavorable in the market, but yet the numbers show that it is the time to get back into the market. So just real quick, wanted to just go back in time and finish with this. So here was the last market crash, where the S&P 500 in 2007 went from a high of 1576 to a low of 666 before it was all said and done. Kind of a bad number, huh? But that's where it bottomed. And here's your three-wave downtrend that I talk about happens. And so this went, who would have ever thought at the time when this was going 13, 14, 1500s that it would actually go down to 600s? And so sometimes we may be out here and the market may go up for a period longer, but I would rather be out in the 12 and 1300s and avoid it going from 15 to 600s, and still have twice as much money in my account in the 12 and 1300s as the people in the 600s, and having even missed a little bit more of upside potential, but knowing that the risks were high. And then once the three-wave move happens, PE valuations compressing it low, and the price gets very far stretched away from its 200-week moving average to the downside, then we start our averaging in technique and get a fairly low price. We are patient. We'll ride out the next few years or so and ride our way into a nice recovery. So it's a very logical way to invest, and that's why I call it the logical investor. So I hope this has helped you. Again, if you're interested in looking into what we do, you can go to SeanHyman.com. You can see the spelling of my name right there. You'd go to the premium tab, at SeanHyman.com. You click on any headline, and you can scroll down. There will be a sign up button. Click that. You can sign up for $97 a year. You will get, I swear, probably what is like equivalent to a college education in the stock market. So it's so much better, in my opinion, than the stuff that you have heard or learned in school. So there's a lot of theory that's really taught by professors in school, and then there's what really works in the markets. And a lot of times that's very different from what you may have even learned in college if you took an economics class or what have you. But I can teach somebody who's never gone to college, has gone to college, that has a finance degree, that somebody who doesn't have any degree. So I would love to help teach you a very logical, methodical way to invest in the markets. And so thanks for watching, and God bless. Bye-bye.